Hey, welcome to the next video in the shares series. This is the third one, and we're going to talk about selling shares now, and with the idea that we want to try and make money here. Sell them for more than what we bought them for. And here you've got an old dude looking at a newspaper. These days we would look on the stock exchange website to get those listings of companies and the buying and selling prices, but you could look at it in a newspaper, because you need to make a decision. Do you want to sell? And when you see an advert like this down here, or ore prices up 165%, and you've got shares in iron ore, maybe it's the time to sell and make a profit. But you know, at least you want to do this. You want to break even. What does that mean? Well, overall, the money you've spent in buying the shares, and that included GST and brokerage costs, and now when you sell them, and that's going to involve costs as well, you want to make sure you don't lose money overall, because you have got some charges in there to account for as well. So let's go down and have a look at what's involved now in selling shares. Okay, so come down here, and there we are. Now, we're going to do the same sort of thing as what we did with buying. Person selling shares receives the amount which you would sell them for, called the consideration. So if you're selling 1,000 shares at $4.50 each, then the consideration would be $4,500, just as when you were buying them. But this time, you will lose money from that, because you've got to pay the stockbroker and you've got to pay the 10% goods and services tax. So this time you're going to work out the consideration and take off your charges. Okay, so just keep that in mind. Let's come down and have a look at that in action. So here's a couple of examples from Hayes and Harris General Maths textbook. Okay, so grab that and have a look at it. So calculate the proceeds from selling 900 Coca-Cola shares at $6.30 each if brokerage is 2.5%. Consideration as before, 900 by $6.32. That's what you're considering selling them for. But now you've got to take off less brokerage, which is 2.5% of this figure here. So there it is. And then you've also got to take off 10% government charges, GST, calculated just on this line here, goods and services, 10% GST. So overall, you're not going to get your consideration. You're going to have to take those two charges out of the total. So setting out is important so that you are describing what's going on there. Let's have a look at this one down here now, a little bit different, because this time the brokerage is a $25 flat fee. So 4,800 shares at $2.13. The consideration is 4,800 times $2.13, comes to that amount. That's what you hope to get for them. But hang on, don't forget the charges. You've got to pay the brokerage fee, which this time is just $25, so it's a straight $25, and then take off 10% of the $25 for GST, 10% GST, and that's $2.50. So you're going to lose a total there of $27.50. So that's important. You can't just ignore the fees. So I'm going to just go back again there. We skipped a bit. Okay. Now, are you ready to do the same thing? So I'd like you to copy down that example there, or look at it in your book, and then use the same approach for each of these. Fairly simple maths at this stage for those things. All right, so pause presentation, have a go at the first one, and then fast forward and look at the answers. I'm going to show you the answers now down here. So there are your answers. So just go toggle backwards and forwards. As you do one, I would suggest you do mark it so you don't reinforce an error all along the way. Make sure you're getting it right. Okay, let's go down and investigate this a little bit more. On the opening screen, I did mention we want to break even. Overall in the deal, we don't want to lose money due to charges. So we've somehow got to build in to what we're selling them for an amount so that the charges are covered. Okay, So first of all, what does break even mean? I think I've sort of explained that already. The break even price is the price at which a set of shares can be sold without losing any money on the investment. So you've got to somehow get back your charges, because you've actually paid more when you bought them than just the consideration. Charges were added on, and then when you sell them, you're going to be charged again. So you need to build into your selling price a little bit more so that you will cover those charges when you both bought them and sold them. Does that make sense? Now we're just going to use the formula here. The break-even price, that's the price of the shares. If the brokerage was done as a rate, we'll use this formula, where R is a brokerage rate as a decimal. So you've got to put it there and there. And B was the buying price. So to the buying price, you have to multiply by this creature. And that's a mathematical term to recover the charges, both on buying and selling, because you'll be charged at both times. So if you wanted to look at that, you can have a look at the derivation of that in the Hayes General Maths textbook. It's not in this course to actually be able to derive that formula, but you must be able to use it. Now there's a different formula, obviously, if there's a flat fee, because with a flat fee it doesn't depend on the overall initial consideration. So the formula is much simpler. Break-even price is you look at the buying price and then you add on 2.2 times the flat fee divided by the number of shares. Okay, so that's a built-in sort of formula to allow you to make sure you get your fee money back that you paid both when you sold them and when you bought them. Okay, so that's the idea. All right, so we're going to practice just using those formulas now. So let's come down and have a look at that. So here's an example. Calculate the break-even price for shares bought at $5.80 each with a brokerage rate of 2%. So the formula you're going to use, write it down, is that one. It's got R in it because you were charged a brokerage rate. And now let's look at it. The initial price was $5.80 and your rate was 2% that you were charged for brokerage. So it's built in so you get those charges back. So sticking the numbers in place of the letters here, it's a fairly simple application of that rule, and you'll find you actually have to sell them at $6.06. And then you would only be covering costs. Cover all costs. So you would be what we call breaking even. Why would you do that? You might pause the presentation, and why might you sell shares if all you're going to do is get your money and charges back? Okay, pause it and talk to your classmates about that, and your teacher. Come back, what's the answer? Did you get an answer? Well, maybe the shares are going down rapidly, or you think they're going to go down, or you might need the money. Okay, so you're working out what you can sell them at without overall losing, and sell them now for that, so if they decline in the future, you won't lose money. So there's all those sorts of ideas. Okay, so come down and try a problem or two here from Hayes 4E. And again, I'll get you to try these and toggle forward in a minute to where I've got the solutions on a later window. Okay, have a go at that, just using the formula. Let's have a look at the other one now, and the situation where we have a flat rate. So here we are, 400 shares you want to quit, and they were bought at $3.20, but you had a flat fee. This is an easier formula. Write the formula down, and it's 2.2 times the brokerage fee divided by the number of shares plus the cost of the shares originally. Okay, so you just got to watch applying the formula correctly, put the correct numbers in the spots, and it's $3.36. So you can see it's always a bit more than what you paid for them, because you're remembering now you cover the costs of buying and selling so that you overall have lost nothing, not even a cent. You're going to break even, they say. Because you maybe want the money, or you suspect the shares are going to go down, so sell them while you can still at least get your money back. Okay, so practice that one. I'll give you some little problems here from Hayes. So 2 through 6. And again, try it and try a problem. Make sure before you do a whole lot of them that you got the correct answer. And I'll show you the answers now. So come down here. And here's some answers for you to the first one as well. And just check that you are going correctly there. All right, let's do a final little thing here. And this is going to apply if you get to what you really want, and what you really want is to make money. Okay, and this is called increasing your capital gains, not capital city. You started with a few $1,000s and you bought shares and you paid fees. Now you're selling them, let's say, at a profit, not breaking even, you're actually making money. And you want to know, how much have I made? Capital gains, a gain in the capital or amount of money you had. So it's the total proceeds minus the total cost. So this time you've sold for more than the break-even price, and you're going to do a calculation to see how much overall you have made, how much you have increased your capital. And later, of course, I've got the bad news for you, and the bad news is that the government will treat that as income, and they will want to take some of their income tax from that. Okay, so Sonny purchased 1,950 shares at $3.15 each. Sold them a few months later for $3.78 each. If brokerage is 2%, calculate the capital gain on the investment. Okay, so you've used the same broker and it's 2% for buying and selling. So first of all, let's work out the capital involved in buying. So here's a consideration, add 2%, then you've got to be charged 10% goods and services on that, which gives you this. So you've outlaid this amount of money. So that was the capital cost, if you like, of buying the shares. Now let's look at the capital proceeds, consideration, selling them for more. So it's 1,950 times that. That's looking good. But then you were charged 2%, so you've got to subtract this, 2%, and the GST have to come off. Those two have to come off. So you're down to your final capital return, if you like, of $7,208.84. So what is the gain? This time they aren't equal. You haven't just drawn even or broken even. So it's total proceeds minus total cost. There it is. You've made almost $1,000, $951.13. I think the message here is don't get too excited about the difference between these first two figures, the considerations, because you've got charges lurking in the background every time you get someone to do the transaction for you. All right, come down now and have a look, and I'll get you to work out how much money you've made. And later on we might play a game where you actually try buying some shares, sitting on them for a while and seeing what happens and whether you can make money. All right, 4F1 from Hayes' book here. Now we've got 5 questions. I want you to go through the buying and selling process and then see if you have made or what capital gain you have made. Okay, pause it, have a go. I'll take you to the answers now. There they are, the answers to those 5 questions. So that's all I want you to think about here from this video, and I hope you're getting excited. It's interesting stuff, isn't it? But you can't gamble, you've got to be careful with money. So think about all that's involved, the charges and so on, and we may later on learn to make some decisions about buying and selling. All right, for now though, it's cheers from me.